So today we're taking a look back at the BCE debacle and we're going to identify the problems and tell you if there is any hope for other telcos. Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast, and I have been waiting to put the final nail on the coffin for this show for a while. Finally happened, so it's going to be an interesting show. I am with my co-host Vero today. Are you ready for this one, Veronique?
I am. Fortunately for me, I sold BC like last year. But yeah, it's not going well for Canadian telcos. Let's put it that way. And it's not new, but it has never been more true. BCE viewed as a bond proxy by many recently slash its dividend. So it creates a blank to fill. And this is what we will discuss today. What was attractive about telcos, what they brought to investors, and which industries or companies could play a similar role while being safe.
Yeah, and to be fair, while we are recording those shows to have fun, but I'm definitely not making fun of you if you held BCE and they slashed your
Right.
dividend. There's no fun here. There's no fun when people are losing money and we don't just celebrate bad news. And actually I can understand your feeling because I've been disappointed and failed by some of my stocks over the years. So definitely not something that is great because behind those bad news, we have shareholders that are hurting. Like investors that thought they could count on companies like BCE to fund their retirement. And one day they wake up and they're just like, yeah, well, they failed me and I don't know what to do. So the good news though, the glimpse of hope here is it is a great occasion to learn and to understand what really happened, why it happened, and maybe try to make sure that you don't have similar companies in your portfolio today that
Mhm.
you can review and avoid the next dividend cut.
All right, so we cannot record this without like first reviewing what happened with BCE. So what led the company to such a disaster?
Well, long story short, bad management, very bad management. So the thing is, we have a business that cranked up a lot of debt that has limited growth. And then interest rates started rising. So some people will say, well, it's not really their fault. Interest rates started to rise and now they got caught there. Well, they kept on increasing their dividend for a long while they knew that the debt was just growing and they were literally financing part of that dividend by issuing more debt. The growth was not there. So the thesis of like we're going to generate more cash flow was not happening. And they kept on increasing the dividend for a while just to please investors instead of doing the hard thing. It's like if you're a parent and you keep on spending and saying yes to your children all the time, but you cannot afford all the things that you're buying. Well, one day or another, you're gonna end up telling your children, "Well, this summer we're not going on vacation. Like it's over. There's nothing left. The credit cards are maxed out, and now it's literally time to stay home and trying to pay those bills." Well, this is what happened with BCE pretty much.
Are there hidden red flags that dividend investors missed before BCE's dividend cut? And how can we avoid being caught off guard like this again?
Yeah, so BC's story remind me a lot of what I've suffered with Algonquin, meaning that I've put a lot of emphasis on the story, on the narrative of Algonquin, and less about the numbers. And this focus on the great story where this business will continue to grow by acquisition and the greening process and the trend for renewable energies and all of that, that kind of like blinded me to say, well, maybe I should look at funds from operations and FFO per shares and the ability of the company to pay, or to look at their balance sheet and realize that yes, they benefits from very low interest rate to grow by acquisition, but most of it is in variable rates. So when you focus too much on the story, and for BCE, that was a great story there. I mean, a big telco, been around for decades, being paying dividend for decades, recurring cash flow from subscriptions. I mean, you have your cell phone, you have like cable, you have internet, you're paying those things all the time. So stable, predictable cash flow coming up. They are operating in an oligopoly. I mean, what could go wrong, right? And I've been told that several times while we downgraded BC at DSR back in 23 the first time with a warning about the company's not doing that well. And people kept on telling me, "Well, great narrative. I mean, yeah, but what could really go wrong are the numbers. When you find a business that has little to no growth, but their costs are rising and they kept on rising their dividend at the same time, that's not sustainable, plain and simple. And that's what happened with BCE. And in those kind of like situation got even worse at one point because management, instead of like sitting down and crunching the numbers and realizing that they did not have the budget to do everything they wanted, similar to again parent with like bad management skills, money management skills, well, they decided to sell assets to pay off debt, which was great. And then 7 weeks later, they shift their mind and said, "Oh, you know what? We're going to buy more assets instead, and we're going to get into more debt instead of paying off our debt." So again, it's literally like saying, "Oh, I'm going to sell my car to buy a boat." Well, you have not paid any debt, and now it's going to be more expensive down the road. And today, well, they are spinning off this dividend cut to say, well, it's more opportunities down the road. We're going to have like more cash flow to fund Ziply growth, where the reality is they still not have enough cash flow, and they had a partnership to have PSP investment to grow a part of Ziply expansion. So like there are two reasons why they did that. The first one is obviously they don't have enough cash flow on their own. Like not many people have mentioned this point. And the other one is by letting PSP having 51% of this new entity for the growth part, the expansion of Ziply, that enables them to not show that debt on their balance sheet, even though they have 49% of it. So you can see how they're still not out of the woods yet. It's yes, it's one step going forward. And the market actually celebrated the cut where by putting the shares up by about like what I think was like around 5% on that day. But it's just like a short-term signal to say, oh, you're doing the right, like the market is thinking that you're doing the right thing, but it's like one
Mhm.
step. And I love to hike. I'm a big hiker. I mean, if you're just celebrating after one step, you're definitely not at the top of the mountain yet. You're still
Right.
at the ground. It's gonna be a while. You're gonna sweat, and they're maybe going to have like more challenges ahead. So nothing is set in stone for BCE moving forward. They just take finally one adult step in this process.
And Mike, do you feel like me? Like I'm a bit mad at management currently. Besides being a previous investor, I mean, this is like a good Canadian business story that they are destroying too, right?
Yeah, unfortunately, we all wish when we invest in a business that we're going to hold on to those shares forever, right? That's always my premise when I start analyzing a business is, oh, I want to hold this thing for decades. But things change. The economy is changing, the market is changing, management is changing, and some management team are actually worse than others apparently. And unfortunately, most of the time we realize that way too late in our investment journey. So this team definitely a big fail, similar to what happened with Algonquin, actually. So I can
Mhm.
relate to BC shareholders for that reason. And yeah, I'm with you there. I'm definitely mad when you have a great business that you can find a way to turn that around and I mean, destroying value, literally.
And unfortunately, it's not the first time a telco has hurt investors' portfolio. We can't help thinking about AT&T here, right?
Yeah, and it's kind of ironic because as of late, there is a glimpse of hope because even though AT&T's dividend triangle is relatively weak, so they still show the same problems where revenue and earnings are not really growing, but the stock price went up from 15 bucks in November 23 to above $27 right now. So there is some hope. I mean,
Mhm.
fortunately or unfortunately, some investors will just remember this part of the story and
Right.
just think, okay, so I'm going to hold on to my losers because they're going to come back. Well, first,
Mhm.
most of them never come back, and some of them will, but will take 5 years or forever to come back. So just like be careful with that hope, because it could create a big opportunity cost in your portfolio. For AT&T, it was a similar story back then when they cut their dividends. So bad investment, a lot of debts, too much to handle, management like did poor decisions, and eventually they decided to make the hard decisions. So they cut the dividend, they spun off the bad investment. So they went into like media and content production that did not go well, like with the acquisition of direct TV and all of those things. They wanted to diversify, probably because they thought wireless and wireline businesses are not going to grow as fast as it was
Mhm.
before. So we need to find new growth vectors. That was a bad move. That put them in a very bad situation. And now it's getting a lot better, even though the dividend triangle is not crazy. They did not increase their dividend since the cut, but they focus on generating stronger cash flow. The market likes this, and this is why it's getting a little bit more love right now. Now, is it's going to be the same thing with BCE? That's another story. I mean, each company is different. You cannot just say, oh, this is another Algonquin, this is another BCE. I mean, each company, each story is different. So we'll
Right.
have to wait and see what's going to happen. As long as the same management team is in place, I'm not that confident, to be honest.
The big question: are all telcos on life support, or are they still healthy ones?
That's an interesting one, actually. Yeah, well, I just said they're not all the same. So on the U.S. side, we still have the classic Verizon and AT&T. I mean, Verizon did not cut their dividend. They still have this profile of being a deluxe bond, high yield, increasing a little bit every year. Not amazing, but I mean, they generate more cash flow. Their cash flow operation is increasing for both AT&T and Verizon. So there are some hope there. I consider them, again, like deluxe bonds. They were before, there still is. AT&T did not increase their dividends since the cut, so I would not be tempted to go after this one. If you now go back on the Canadian side, while Rogers is suffering on the stock market, they had to make a big move by acquiring Shaw Communication. So that means a lot more debt, still struggling with growth because, I mean,
Mm.
wireless, wireline media business not exactly thriving these days. So the investors are a bit upset about all of this. There is Telus and Quebecor that could bring some hope on the table, maybe.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. So, what should investors expect by holding shares of Telus and Quebecor? Like, what are the investment thesis?
Yeah, so to be clear, Telus is doing good in 2025. But as we mentioned last week in our episode about stocks that are performing well in 2025, they're in recovery mode. So a lot of stocks that lose like 20, 30, 40% of their share value, maybe at one point they're going to be up 15%. Not that impressive. And this is the case of Telus right now. I was close to sell it last year, and I was quite transparent about that. I determined like specific metrics, which are like the cash flow metrics. So we have cash flow from operation, we have capital expenditure, also known as capex, so how much money they invest in projects, and free cash flow. So the point here was to show cash flow from operation growth. So I wanted the company to increase the cash flow. That was the promise. I mean, for more than 10 years, they had low debt. They said, we're going to massively borrow money, invest in our future to generate more cash flow. Well, we are in the future right now. It's time to pay
Right.
off. So, more free cash flow as well. Free cash flow to be able to pay the dividend and increase it, and less capex. So, smaller investments to actually balance everything's up and hopefully opening the door to some debt repayment, because it's nice to have more debt to invest in the future, but one day or another you still have to pay that down debt. So to pay that debt down. So in 2024, all those metrics improved. This year they kept on improving, and I was happy because management said, you know what, because our cash flow metrics are improving, we are going to continue increasing our dividend through 2028. Of course, we're talking about 3 to 8%. I'm not stupid. I'm thinking more 3% than 8. I mean, if I get more than 3, that's going to be fine. But again,
Mhm.
I don't want Telus to be like Bell and increase their dividend just to please me. I want them to increase the dividend if they are making more money. So
Right.
as long as cash flow metrics are getting better and the dividend payout ratio is under 100%, so by the end of this year, it should be around 80% of their cash flow, which is not ideal, but it's decent. It's enough to be sustainable, especially if you expect a 3% growth of the dividend. So, as long as all those conditions are met as we continue moving forward, I'm going to hold on to my shares. Not going to be super happy because, of course, over the past 3 years, I did not make much return on that investment, but
Mhm.
it's also part of the game. Moving on to Quebecor, big surprise here. Like it's kind of crazy. It's similar to Philip Morris that we have discussed last week, where I'm not convinced of the investment thesis, but the numbers are there. So very strong dividend triangle, great performance, revenue, earnings, dividend increasing a lot faster than other telcos. I just cannot get my head around the narrative. I really like the acquisition of Freedom Mobile. So what happened is when Rogers acquired Shaw Communication, they had to sell Freedom Mobile to make sure that they do not look like a monopoly too much. So
Mhm.
Quebecor was there. So it's opening the doors to wireless services across Canada. So their wireless and internet business is doing great. But the media division, the cable, like it's still a huge part. Like Videotron is a big, big part of
Right.
Quebecor. So I'm not convinced about this part. And I don't know, like so far they've been doing great, but I'm still on the fence about this point. But definitely they're doing something good. So there is still a glimpse of hope around the telcos for sure.
Okay, but in other words, their role is quite different from the one that BCE and AT&T like used to play. Like investors have or had BCE and AT&T in their portfolio for like stability, higher yields, and reliable dividend payments, right?
Yeah, so I always describe them as deluxe bonds, as I said. Not big on price appreciation, but a good dividend, a good yield, and the dividend will increase to roughly match the inflation. For years, BC increased the dividend by 5%. AT&T showed more than 25 consecutive dividend increases before cutting it off. So they were doing great. But that's the problem with a lot of what I call those deluxe bonds or bond proxies is they are walking on a thin line. On the one
Mhm.
side, they provide everything that a dividend income investor is looking for: a stable business, recurring cash flow, and a high yield. But they are offering this high yield because of limited growth. And if they hit too many road bumps on the road, they come into a problem. And this is exactly what happened with BC and AT&T is they had the same problem. It's a capital intense business. So they need to invest massively just to maintain their network. And on top of that, because of competition, they always have to improve, enhance, invest in new technologies. We had the 5G that came out around those years, and that is slowing down the business big time because a big part of their cash flow is directed to this capex. So when
Mhm.
you combine capital intensive business with poor management, then you're trying to dig a hole, right? You know, it's you're just getting into that hole, and then it make it very difficult because you have limited growth to get out of this hole and start paying back down your debt. So if the business was able to find growth vectors and show revenue and earnings growth of like 5, 6, 10%, well then that would have not been a problem. But it's like you have a stable job but with no possibility of getting a promotion, no possibility of increasing your paycheck. Actually, there will be no pay raise this year, and yet you buy a sports car with high maintenance fees, with big payments. And at one point, if your dishwasher fails or if your roof leaks, that's going to be the end of it. I mean, you could not afford a sports car, yet along the maintenance, and then you have another tile that is breaking on your ceiling and hitting you on your head, on the head. Well, there you go. You get to the dividend cut at this point. So it's really dangerous to navigate with deluxe bond for that reason. You have to constantly monitor. You have like great stories like Power Corporation, for example, that has been this perfect deluxe bond for the past 30 years. But many of those, it's a little bit harder than this.
Okay, so if telcos were once seen like the backbone of safe dividend income, what changed in the business model or maybe the industry landscape that makes that no longer true?
Well, we had a decade where people starting to use smartphones. I always have this fun conversation with my youngest son Caleb. He's 13, and then he cannot figure out that I grew up as his age without a phone in my hand. He was like, "You had no phone? Like, what do you mean you had no phone? Like, your parents didn't want you to have a phone?" I'm like, "No, dude. There was like it didn't exist. So
It was a
so it's
landline.
yeah, a landline, good old landline. And then like the luxury was having two landlines. So that was
Right.
crazy. I had like my own. That was like the big thing. But yeah, now you have a smartphone and you can almost go on the moon with it. So it's kind of like how things evolve. But those companies benefited from that, like the internet, wireless services, all of that came in. Plus, they benefited from like more than 10 years of low interest rate to keep
Mhm.
on growing. So I think everyone became complacent at one point. Big tailwinds come in, the money's almost free. So both shareholders and management just said, yeah, well, everything's going to be fine. It's going to continue this way. Well, now the golden ages of wireless, I mean, it's still a necessity, but it's not growing as fast as it used to. So it
Mhm.
becomes more like a utility business. It's like stable, recurring cash flow, but don't count on like a telcos growing their revenue like double digit like Microsoft would do. That's not going to happen. And
Right.
now with higher interest rate, the interest charges started to weight a little bit more on their budget. So it's time to have like real management teams taking like big decisions and also trying to evolve once more, trying to find new growth vectors. And this is what they
Mhm.
did. And some of them failed miserably. For Telus, they tried with Telus Agriculture, Healthcare, and Telus International. It didn't miss so far. So one year is doing well, the other year is struggling. The jury's not out yet. I was more optimistic about those growth vectors a few years ago. Today, I'm like, yeah, that's going to be okay, but it's not going to be the next big thing either. So
Mhm.
that's why it's important to look at how the industry is changing. And again, diversification is the key. I had like a 2 or 3% position in Algonquin back then when it cut their dividend. So when I sold, I'm like, okay, that hurts, but really it wasn't that bad. If I had like 10%, 15%, 20% in a stock, well, this is where the diversification comes in. So while you may be losing money with Bell, you're probably making money with something else in your portfolio and it's all good. So it's just a matter of like cleaning that portfolio, making sure you have those backbone companies that are going to continue to be a solid foundation moving forward.
All right, but Mike, let's like help investors who want to move away from telcos. Like maybe some people just sold their shares of BCE. So how can investors find similar companies offering like a similar value for their portfolios? And what kind of companies or sectors would you start with?
I just want to start with don't take anything for granted. So, yes, we're going to talk about a few sectors now, but I mean, just for example, Google was the go to search engine like for years, right? I mean, we even say, well, Google it instead of like research on the internet using Google. But now I hear more and more people using ChatGPT and other AI for their
It's
research.
true.
And I mean, not too long ago, we have discussed that like you plan your entire trip to France using ChatGPT. When I was in Martinique, there was like seaweeds on some beaches. Instead of like going on the internet or using Google, I just asked ChatGPT, find me a beach where there's no seaweeds. And it worked. So I did not have to go to Google. And if I don't go to Google, well, they're not going to make money on with their advertisement. And this is how things could change super fast. So if you're looking today for stable dividend stocks, deluxe bond like, you're going to find them in several industries. But you need to look at mature businesses that are relatively stable. The one that may probably be right forever is the utility business. We need power. We're going to continue to need power. Very similar to the telcos in the sense that they are capital intensive. So it costs billions to maintain the power grid, to improve it, and so on. Usually they operate into either oligopolies or monopolies when you have like regulated utilities. They will distribute roughly 50%, sometimes even more of their profit and dividends. And they're not going to grow that fast. So that would fit the bill. You have some REITs as well, real estate and income trust. You have to be careful. You want to make sure that the REITs that you invest in still increase their dividend, their distribution. Many of them, they offer a high yield monthly payment with no distribution increases with high FFO payout ratios. You have to be very careful about those because it's not
Mhm.
exactly screaming dividend growth. You have pipelines, Enbridge, Pempina, TC Energy, great pipelines as well. Energy partner on the US side, EPD. So you have a few of them, but again, we also have famous stories in the utility business cutting their dividend, like Algonquin or Dominion. Same thing with pipelines with Kinder. REITs are legends. Maybe like banking industry, you have like life insurance businesses. They offer a high yield, but again, Manulife cut their dividend after the financial crisis. Great West and Sun Life did not. The three of them today, they're doing great, and they are offering a yield around like 4 or 5%. So that's great. Canadian banks, it's been a while. We have seen a Canadian bank cutting their dividend, but I mean, it's ironically happened to National Bank in the 90s. So you never be sure, right? So this one has been my favorite for the past 20 years. And yet 35 years ago, they cut their dividends. So it was a different business back then. Yes, it can come back from the dead, definitely, but things have evolved a lot since that dividend cut. So if you're looking for companies that offers a 4 or 5% yield and has some decent dividend growth, you're on the right path. Don't invest in like 5 utilities or 5 pipelines because your lack of diversification. And if one has problems, as we discussed today with the telcos, I mean, we focused a little bit more about BC and what happened with AT&T in the past. But if you look at total return for Verizon and Rogers, you're not going to be that impressed. Telus over the past 5 years is pretty much dead money as well. This is the same story for everyone. They're facing the same challenges, right? So high capital intensive, high interest rates, little growth. Well, they're all the same. So they're all going to generate similar returns and face similar problems. So you have to be careful of that diversification in your portfolio, not to get caught up with 25% of your money invested in the same place struggling.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Okay, and some investors are tempted to buy BCE now or like Verizon or whatever, thinking it's on sale. So what would you say to them?
Well, we just got a good story with AT&T, so they're gonna put that on my face if I say, well, like consider it twice. Again, I mean, you always have those great stories, but you don't talk about the bad ones, right? The hope of a comeback is always seductive. And it's the same thing in sports, we like there's always a good portion of people that will cheer for the underdogs. It's just fun to see someone that you do not expect to winning. That's
Mhm.
great.
Right.
But unfortunately, most of the time, underdogs they fell, and the big team is winning. And it's kind of like the similar story with businesses. And I'm not saying that BC is not going to come back, but instead of like trying to hope or not hope, well, how about you focus on numbers and metrics and strategies? So, what exactly BC needs to do to come back? That is the real question. So, for once, they need to pay off their debt. They need to improve their cash flow. So that means they need to find growth vectors that will help them generate more cash flow so they can pay down their debt. Right now, they're a little bit more thinking about expanding Ziply. So now you have a decision about is Ziply's going to really be a good decision for the expansion, how much is going to cost, and are they going to go into the same story of, oh, now we need to borrow money because we're going to buy into this assets and we're going to make it grow. Well,
Mhm.
if they repeat the same story, chances are they're going to have the same ending. So you have to be careful about that too. And the numbers are going to tell you a lot more about the story than what management has to say on their earnings calls. Because, of course, they're going to sound very positive and they're going to talk about how the growth potential and opportunities. But really, BC has not grown in several years, and the dividend has just fallen for that exact same reason. So I would really focus on numbers at this point and making sure that those numbers follow up with the strategy that is being announced, the plan that is being announced by management.
So, Mike, in summary, what lessons do telcos give to investors? Like, do you think the BCE cut will influence how investors evaluate other like high yield, safe sectors, like you've mentioned, utilities or REITs or others?
I hope it will. I don't think it will. I'm not that optimistic because I mean, BC is not the first great business with a great reputation to fail their investors, and it's certainly not the last one either. We keep being seduced by those great narratives, and for most investors, they don't necessarily want to dig in that far into financial statements. I remember last year I dig into BC and Telus financial statements. It took me hours and I had fun doing it because I just love to play around with numbers, trying to understand like, okay, so interest rate is increasing. Everybody gets that, but what's the real impact on their balance sheet? And now you have to go into the interest charges and you have to compare them to the last quarter and the last year and to see the trend. And then you have to look at this chunk of money that is being paid in interest. And then you look at the chunk of money being paid in dividend. And then you look at the chunk of money being paid in capital expenditure. And now you're adding up those numbers and you realize, oh my God, there's not enough free cash flow to pay all of that. And most people don't find that interesting. So that's a problem when you're getting to that level. For most companies, it's all right. You have a good narrative, you look at the numbers a little bit on the chart, and then you're happy, and then you move on. That's perfect. Once in a while, when there's a problem, you need to find those answers, and it's important to run those numbers, to crunch those numbers. And I've seen this by many investors, either on X or on YouTube, saying exactly the same thing as I said. I mean, this is not sustainable. They did exactly the same exercise. They came with the same conclusion because this is math. I mean, there's no hope in math, It's just like pass
Right.
or fail. You have either the good answer or you have the bad answer. And that's pretty much it. So I hope that investors will learn from this unfortunate story. And they will hope that sometimes when things doesn't look good, at least do the effort to look at people talking about numbers if you don't want to crunch them yourselves. There are plenty of people like me that are actually making this as a passion. But every single time that I discussed BC on my YouTube channel, on this podcast, and my newsletters for DSR, I always got people answering back saying, Mike, you don't get it. It's been around for a while. I'm not worried. You panic for nothing. So I'm like, all right, so those are like the numbers. I'm not panicking. Actually, I don't even own the stock, so I couldn't not care less about the investment and where it goes, right? It
Mhm.
will not and it has not affect my investments. But that's the unfortunate truth. So just give numbers a little bit more room in your investment thesis, and you're just going to become a better investor with this and hopefully avoid a few bad mistakes like that one.
So if you're like me and you don't like math that much, you can subscribe to dividendstocksrock.com or get a glimpse of what we do free with the Dividend Rockstar list, right, Mike? How can this list help them?
Yeah, I think this is probably like one of the most added value that we have at Dividend Stocks Rock is we do the heavy lifting for investors. So what you need is a little bit of time and a little bit of interest to look at the graph, look at the dividend triangle that we provide, and read the analysis that we provide, and then you're going to be well ahead in your investment
Mhm.
analysis. The Rockstar list is kind of like the first step of this because it's the research that we do through our stock screener. We package it in a simple way. So, of course, DSR members have access to a lot more metrics and they can tailor it
Right.
exactly to their liking. But the Rockstar list will give you a great starting point because we are looking at numbers. We don't care about the story. We don't care about this company is great or not, or their growth vectors. We're just looking at, is this business been able to increase their revenue, their earnings, and their dividend over the past 5 years? And if so, they are on the list. If not, they're gone. So it's a great way to narrow down your research. Then you can narrow down by sector, and then you're going to read a few investment analysis to pick the best sector, the best stocks for your portfolio. So you can download the Rockstar list. The link is in the show notes, of course. Which is great is once you subscribe to the newsletter, you're going to receive the updated list every single month. So you don't even have to do the research anymore. We're doing it for you.
So thedividendguyblog.com/rockstar. Thank you, Mike, for helping us move beyond telcos or maybe reset our expectations about them. Listeners, remember to download your free Dividend Rockstar list at thedividendguyblog.com/rockstar. For our show notes and related content, visit thedividendguyblog.com/231. Next week, we will go a different direction and discuss why you should not invest in dividend stocks. Make sure you do not miss it. Hit the subscribe button underneath our podcast logo and leave us a 5-star rating. Until then, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.